Good morning. You are watching a live daily market outlook for Thursday, 26th of April 2012, prepared by Windsor Brokers. The dollar is trading broadly weaker after yesterday's Fed's decision to do little to change perception. It's committed to a dovish stance. The euro is steady, keeping around its fresh highs, fresh 3-week highs. While dollar fell to 7-month low against Canadian dollar and sterling, with the dollar index down approximately 0.1% from the opening to the zone of 78.96. As said, Federal Reserve Chairman Ben Bernanke said yesterday that U.S. monetary policy was more or less in the right place, even though the central bank would not hesitate to launch another round of bond purchases if the economy were to weaken. In the statement after a two-day meeting, the Fed's policy setting panel reiterated its expectation that interest rates would not raise until late 2004 at the earliest, and it took no action on monetary policy. The Fed also adjusted its economic forecast to acknowledge an improving labor market and slightly higher inflation over the next few years. They revised the forecast along with a change of heart by the most dovish Fed officials on the timing of the first rate rise, suggested the central bank has grown somewhat less inclined to take more action to help the economic recovery. As rather negative data, the rather negative comments for U.S. dollar that were released yesterday pushed the single currency and sterling to the fresh highs, while the dollar fell against Swiss franc and also losing ground against Japanese yen. Commodities were broadly higher after the Fed's decision, with gold escaping from the dangerous zone and regaining $16.50 per ounce. This is the current price of the yellow metal, as well as crude oil that jumped slightly above 104 dollars per barrel. From today's calendar, Australian CB leading index already released, no change, while more significant are Germany's preliminary CPI for the regions that will be released during the day. U.S. unemployment claims are the weekly unemployment claims are due at 12:30 GMT, and a slight decrease to 377,000 compared to 386 of the previous weeks is expected. At 1400 GMT, we have the March U.S. pending home sales that are expected to pick up the pace in March with 1.2% increase seen compared to the contraction of minus 0.5% of the month of February. And later in the evening, GfK consumer confidence for April is due at 23:00 GMT, with the negative slightly better than the previous one at minus 29. A bunch of data coming from Japan. That will be actually already in tomorrow's trading business, but since the times are in GMT, we're going to mention them. Tokyo's core CPI is expected to stay unchanged at minus 0.3%, while national core CPI for Japan for April also expected unchanged at 0.1%, as well as Japanese unemployment rate for March at 4.5%. No changes. Quick look now at the markets to see the latest movements of the majors and the commodities. As we can see, the euro was well supported just above the main bull trend line of 129.93 low. Yesterday's dips found footstep at 131.72, followed by a strong rally after the Fed's announcment, posting a fresh high at 132.36. That marks also 61.8% of the reverse of the down move from 133.80 down to 129.22. This is also the double Fibonacci level as shown on the daily chart. The longer term down move from 142.46 to 126.22 marks also 38.2 Fibonacci retracement at 132.42. So we have double Fibonacci barrier at this point, very strong resistance as the pair briefly broke above the previous high at 132.23, marginal break higher at 132.35. A positive structure is still seen on the near-term studies. However, the hourlies are still in the rather neutral sideways mode, as no direction at this point is seen, while 4-hour charts studies still in the positive territory. However, some loss of buying momentum is seen at this point. That might be a warning of inability to break this strong barrier at the first attempt. On the daily, the pairs break above 55 days moving average gives the additional support with the momentum breaking above the midline, signaling fresh strength ahead, as well as MACD that is currently attempting to break higher. As long as 90 days moving average at 131.17 and the higher platform at 131.00 hold the downside, there is still potential seen for a further extension higher. On the upside, break above 132.30-40 zone opens next light support. The resistance at 132.52 and 132.77 ahead of more significant 133.00 that marks the peak of the high of, well, we can't find it now, approximately high of March 2012, as well as this is a strong psychological barrier on the upside. On the downside, immediate support lies at 132.15, which is the overnight's lows and range floor, along with yesterday's intraday high at 132.17, while more significant supports come at 132, 131.70 zone, where is also the main bull trend line, and the only break of this would delay immediate bullish structure in favor of stronger reversal with the 131.50, our next very significant support to come in focus. Only break below 131.50 would put the bulls on hold and allow for a deeper correction, stronger correction of the short-term up move from 129.93 that so far peaked at 132.35. However, need to mention that the current near-term structure still keeps the upside in focus, and we need to see the clear break above 132.30-40 in order to resume gains higher. Sterling remains in the strong uptrend following a past 2 days consolidation that was contained at 160.75, 160.80. 160.80 is yesterday's low, and 160.75 low of 23rd of April. That makes the strong higher platform and strong support for the possible further extension higher. The fresh high was seen this morning at 161.94, just ahead of round figure resistance at 162.00 with the positive structure on the hourly, and more warning seen on the 4-hour chart as bearish, MACD bearish diversion sees risk of possible reversal, as the momentum also is waning despite the current gains from last night. There is still a risk seen of a possible upside failure and reversal lower. A firm break above 162 from the other side will open way towards next significant barriers at 163 00 that marks the high of 31st of October 2010, and as well as around the figure resistance ahead of 163.88 that marks 76.4 Fibonacci retracement of the longer term down move from 167.45 peak of 2011 down to 152.33 low of 2012 posted in January. From the short term, as said, key support at 160.75 needs to hold the downside in order to keep the immediate bullish structure in play. Otherwise, loss of this level might trigger, as well as previous high at 160.61 might trigger a stronger correction of the latest rally from 158.17 that so far reached 161.94 high of this morning. The dollar yen lost traction again after yesterday's unsuccessful spike higher that and attempt to break above the main bear trend line of 84.08 peak of 21st of March, as the rally was ran out of steam at 81.68, just ahead of 81.77, our immediate target on the upside. Quick reversal lower and break back below the main bear trend line keeps the negative tone in play and the focus at the downside. The pair is currently holding around the 81 zone, which marks initial support, and the higher platform that holds for now ahead of a more significant 80.85 low of 24th of April, a loss of which would signal further extension of the latest down move from 81.77 20th of April high, and possibly refocus our key short-term support and the target at 80.28. Negative structure still dominates in the rather negative to neutral, I would say, at on the hourly charts, as well as more negative in the 4-hour chart, while daily structure remains in the negative territory for so far. And as long as holding below the bear trend line and the more significant 81.77 lower high, the downside remains vulnerable. As said, the loss of 81 and 80.85 opens next very significant support at 80.28. That will signal a further retracement of the medium-term rally from 76.00 beginning of February 2012 low that peaked it at 84.17 on 15th of March 2012. The dollar Swiss also remains under pressure and continues to trend lower, as the main trend line of 92.50 peak of 16th of April keeps the upside well protected, along with the 20 days exponential moving average as shown the 4-hour chart. The latest, the recent bounce yesterday attempt to break above the trend line was short-lived, as the price was rejected at 91.20, and the quick reversal higher briefly broke below our strong supports at 90.90 and 90.84. So far we have seen 90.74. That keeps the downside firmly in focus for possible return down to 90.00, our next downside target, and very strong support. Meantime, we have the triangle support and the bull trend line of 89 at 30 end of February low, currently standing at 90.43, break of which is to open the way towards 90.00, and the next more significant double bottom of end of February at 89.30. Negative the daily structure, daily studies are now attempting below their midlines. That will turn the broader picture tone more negative, as the pair broke below 55 days moving average, and now we are looking for test of triangle support at 90.43. That will open way for a further weakness on the upside, as long as first trend line resistance currently at 91.68 and more significant 92 and 92.50 stay intact, the immediate focus will stay on the downside. As said, the yellow metal gained some strength after a recent dollar's weakness based on Fed's yesterday's decision and comments regarding 1650 level so far, averting immediate downside risk as the price dipped to 1623 and 1624 in past couple of days, signaling that further weakness and possible test of 1612, our next target, it would be the likely scenario. Improvement in the near-term studies, especially the hourlies that are now strongly pointing higher, and the 4-hour chart studies that are breaking above their center lines, keeps potential for a short-term further recovery, with the barriers at 1655-57 zone coming next, ahead of bear trend line of 1725. Currently standing at 1663 to come next. More significant barriers at 1685 zone and 1697, 1700, regain of which is required to improve significantly the outlook for the yellow metal, as shown on the daily chart. Approximately 1670 is the trendline resistance, and a series of lower tops at 1683 and 1680 ahead of 1697. That is our key barrier. Above this, it's 1698, also the 200 days moving average, and basically only break above 1700 would improve the broadly negative structure of gold off its yearly high at 1790 posted on 29th of February. The daily structure is still in the negative territory, despite some despite the current bounce that regained some momentum. But as said, regain of minimum 1680 is required to avert the broader negative tone and the risk of retesting 1612. That will open way towards 1600 and the key supports at 1522, 1532, double bottom. And quick look at crude oil, that is again regaining strength after yesterday's Fed's announcement and a weaker dollar, as its short-term rally of 100.67 at end of April low has so far reached 105.48, with downside being protected around 102 zone, where is also the where the temporary support was found. Currently, the 90 days moving average on the daily chart follows and underpins the recent rally, currently standing at 102.86 as the price broke above 104 level and looking for test of 104.66, 20th of April high. That will open way towards more significant barriers at 105 and 105.48, along with the channel resistance currently at these levels, with break there that also marks approximately 50% of the retracement of the latest down move from 110.53 to 100.67 to confirm the higher low at 167 and open way for a stronger recovery. On the downside, the loss of 102.86, that is currently the 90 days moving average, and more significant low at 102, 101.80 is 210 focus lower, and the open 167 and $100 per barrel as our next very strong support and psychological support. That was all for today. We're back tomorrow morning at the same time, 7:00 GMT. Until then, I wish you a nice day. Good luck.